Welcome to another edition of Around the Table with Stacy Smith as we take a look at the economy and investing. There are only two more trading days on Wall Street for this year, but what a year it has been, bouncing off the lows of 2022 to set a new all-time high in the Dow Jones Industrial Average, and the S&P 500 is on the verge of closing at a new all-time high. For the year, the Dow is up 13%, the S&P 500 is up 24%, and the NASDAQ is up a whopping 44%. So what happened this year and just what might happen next year is just part of the discussion we're going to have as we go around the table with my panel of analysts and financial advisors. And let me introduce them to you now. First up is Carrie Coghill. Carrie is the president and CEO of Coghill Investment Strategies, which is headquartered here in Pittsburgh. Carrie has been recognized by Forbes as one of the top women wealth advisors in the country. Also at the table is Frank Bracetti. Frank is the managing director of HF Management Company, which is part of an alternative asset partnership. Now, Frank's background includes 50 years in the investing field, and he helped to establish Harvest Financial here in Pittsburgh, where he was the executive chairman. Across the table, we find Kim Forrest. Kim is the chief investment officer and the founder of Boca Capital Partners. Kim has a dual background in finance and in software engineering, and you may have seen her in her many appearances on Fox Business News, on CNBC, and also on Bloomberg. There is one more seat at the table, and that is where we find Michael Godwin with Fergasso Advisors. Michael has a solid career in investing and is the chief investment officer for Fergasso Financial Advisors. And again this year, by the way, Fergasso Advisors is listed among the Barron's top national 100 independent advisors. Thank you all for joining us. I hope that you all had a good Christmas so far and looking forward to 2024. And that's a little bit of what we're going to talk about, as a matter of fact, is 2024, which is coming up. Now, back in September, I did some calculations as to what happens to the S&P 500 for the month of September and then how it ends up for the year. Well, with 2 days to go for the year, this is how it stands. The S&P 500 lost 246 points just in the month of September, or 5.43% of its value. That is historically, though, in line with what happens. But as of the close on Tuesday, the S&P 500 was up 242 points, or 5 1/3 points, from the beginning of September until the end of the year. So that means just in the last quarter, October, November, and December so far, the index has gained 488 points, or more than 11%. And while that is larger than normal as far as the index goes for the last quarter, it is also in line historically that index goes up the last 3 months of the year. The bottom line, the fourth quarter of 2023 has been a very strong quarter. Question now is, will it continue into 2024? No one can say with any certainty what the future holds, but my panel of analysts and financial advisors can make some predictions. So, Kim, you are first up. Given what we know so far, what might we expect for 2024?
So I have to tell you this, that I think people are, by and large, really terrible at forecasting. And we see this in if you compare what the beginning of 2023 had with forecasts from the experts and how it ended up, it was nothing like anybody planned. But that, disclosure being given to you, to do with it what you will. So there's a couple of big things that I think are going to help continue the market's move upwards. The narrowness of 2023 is starting to grow outwards. But what I mean by that is the market was moved pretty much by the Magnificent Seven and then, plus a couple other stocks that drove it higher. And these were the largest companies, and they grew faster than anybody with respect to stock price this year. And most of the other stocks have been lagging. And it feels like in this last 2 months, since November 14th, actually, the market has started to broaden out and more of the smaller stocks have started to gain. And why is that? Our friend, the Fed. So the Fed kind of has indicated that it's softening its stance in higher for longer. Longer might be over, but I again say that this is a presidential year and the Fed does not want to seem like it's throwing its weight towards one candidate or the other, whoever those candidates may be. So I expect a couple of rate decreases in the first quarter, if maybe into the first half, but certainly not in the third quarter. maybe in the fourth quarter. So those are the openings that the Fed has politically to be able to do its work. So it's kind of front loaded and back loaded with like a lot of nothing with respect to rate changes. This is what I'm forecasting in the middle of the year. But I think this still sets us up. Another thing, and I'm going to kick this over to everybody else here in a second, I think that companies have been focusing on adding productive technology to the mix. And I believe that could show up in companies' earnings, along with what we see declining commodity prices. So that could give that could set up the market for an increasing market because stocks may be able to report higher earnings. There you
All
go.
right.
What do you guys have to say?
What do you guys have to think about this?
Well, Stacy, I'm not going to fall into your trap of giving a prediction because, we all have our opinions and we can all look at various things that may or may not happen. But as Kim said, no one knows what's going to happen. And what is important is that as advisors and as investors, we know what we're looking for that would cause us to want to make a change. So we don't know if interest rates are going to go up or down next year, if they're going to get cut 4 times, but we can pay attention to the data. We can pay attention to things like retail sales and the health of the consumer, because that is going to dictate ultimately what happens. There are just way too many moving pieces in the geopolitical world that we live in today, and we'll talk a little bit more about that later in the show, to sit here and give predictions really based on nothing factual, because we're talking about future. That's kind of one of the gripes I have about our industry, is that we are great prognosticators, and I can do it too. But I think for the sake of our viewers, this always comes back to, what are your objectives? We really, the things that really sway the market the most are the things that you wake up to. You wake up one morning and 9/11 happens, or you wake up one morning and now all of a sudden this pandemic is widespread, is really a pandemic. So you really have to stay true to what your guiding investment principles are, regardless of what the market is doing, and look at that longer term time frame.
All right, we are going to take a quick break here, and when we come back, we're going to hear from Michael and Frank about their thoughts about 2024 in just a moment. Welcome back to Around the Table with Stacy Smith as we take a look at the economy and investing. And we're talking about what happened in 2023 and can you make any projections for 2024? So we just heard from Kim and we've heard from Carrie. Kim is very optimistic. Carrie's sitting on the fence here, won't say whether it's going to go up or down because she likes to play her cards that way. And I don't blame her at all. So Frank, your thoughts. Are you sitting on the fence, or are you gung-ho, or are you shying away from a bigger market?
100 years ago, when I was a child, my grandmother said I was contrary as a button. That being said, pretty much everybody agrees with what Kim is saying. This is standard fare. We've got falling interest rate, guaranteed. That's what it sounds like. We've got growing earnings. Absolutely. The only question is how much. We've got a growing U.S. economy. We've got the infrastructure bill adding to it. And all these things are factual and right. And everyone is ignoring the fact that the rest of the world's in a recession. And we're in a global economy. And I fear that malaise in Europe, in China, and certainly the Middle East has problems just because they're busy dodging bullets. With all that going on, how do we stay clear of all of this? It is a global economy. At one time, 60% of the Standard & Poor's earnings were generated abroad. Well, if abroad is not doing so well, how can those earnings keep going up? And that's away from our economy. But that is what ultimately drives the value of common stocks. So I'm not afraid of the market, but I'm not sure it's going to be quite what everyone thinks. I think next year is going to be a lot like last year. We'll look back at what we all said and say, well, we were wrong.
Or you'll say you were right.
Well,
So
Michael,
I
go
want to
ahead, Terry.
push back on something Frank said. I'm curious, Frank, because you said, if I'm remembering this correctly, that we'll be in an environment of falling interest rates guaranteed, and we all know that guaranteed means guaranteed according to Frank's opinion. But I don't agree with. I don't agree. I think there's more risk of the Fed not lowering rates to the degree that the markets are anticipating.
my use of the word guaranteed was pure sarcasm.
Okay. Okay.
But
It wasn't because I
to
think anything's guaranteed. It's kind of like many analysts will write in the foreseeable future. I love those words. All right. That means nothing because the future cannot be foreseen, period. And you can guess what's happening and you might be right, but you can't foresee it.
And to your point, Carrie, it felt like everybody on Wall Street was looking for interest rates north of 6 to be the higher for longer number, and we never got there. So there's always uncertainty around everything in Wall Street.
Michael, I want to bring you. I wanted to bring you on this one, Michael.
Well, I don't want to talk about rates too much, but I think Carrie's right in that it's not going to be cut as much as the market's predicting. The market's predicting 6 rate cuts next year. I think we get something short of that. But one of the things I try to use history as much as I can when looking at what's going on now, and then maybe helpfully trying to predict what we think is going to happen going forward. And I think most market participants forget that, July, August, September, and part of October, really bad months in the market. It was kind of almost straight down. The market was down between 10 and 15% at that time. And only in November, December did we get a huge relief rally or a huge rally. And that was because what Kim said before, the Fed's signaling that they're likely done hiking rates. What does that mean going forward in terms of cuts? We don't know yet. But the market, looking historically, almost always rises and rises a lot when the Fed perceives that they are done hiking interest rates. And it's only when something seems to be breaking in the economy. And for me, I usually look at jobless claims, which I've talked about a lot. That hasn't happened yet. That's when the equity markets are going to run into trouble. So there's a lot of good news, I think, already priced into the stock markets. I'm not don't want to sound like the resident bear here, but I think it's going to be hard to continue to have a strong rally like we saw in 2023 persist into 2024.
I've got a question for you also, and anybody can jump in on this. You talk about the Magnificent Seven and how they have led the market higher for this year. When we say that they've grown, are they grown from their all-time highs or wherever they were, or is have they grown from where they dropped during the 2022?
Well, Microsoft really has outgrown its, it keeps getting new highs. So that's one that you correctly can say, look at that thing. But I think some of the other ones like Google and even Netflix, I guess that's included in the Magnificent Seven, they're just kind of up from their very, very low price at the end of 2022. So that is a good point, that these are not necessarily all-time highs for those companies, but they did outperform the rest of the market in mighty, mighty ways.
I asked that because, as I mentioned, the fact that the Dow is up 13% for the year and set a new all-time high. The S&P 500 is close to closing at a new all-time high, but the NASDAQ is still down from where it's not close yet to setting a new all-time high. So, it dropped the most and had a lot of room to recover. And of course, as we all know, the NASDAQ is tech heavy. So that's why I brought that out. And now that then leads to the question, and Michael, I'm going to throw this one right back at you. If these are going up, these tech stocks, the Magnificent Seven, Kim indicated that we started to see some of the other stocks, broader based kind of influx into the market and starting to go up as well. Is that going to continue in 2024, or how do you see it for the overall market?
Well, I think if the markets continue its ascension that we've seen over the past couple of months, you would think that it would have to be more broad-based in 2024. I mean, just in general, a healthy market is one where there's broad participation in a rally, not one that's driven by, as Kim alluded to, the 7 stocks, which is what we really saw for the majority of 2023. In fact, 2023, I mentioned this before, saw a record number of stocks within the S&P 500 actually underperform the index as a whole, meaning it was only a handful of stocks, those 7 stocks, that really drove returns this year. So going into 2024, if that rally continues, we need to see like the small caps and the other 493 stocks do well. And that kind of put that in a context, Stacy, what we saw in 2023, those 7 big stocks were Apple, Facebook, Microsoft, Nvidia, Tesla, Amazon, and Google. On average, those stocks were up 109% this year. So pretty much more than making up what they lost in value in 2022. Nvidia certainly hit a new all-time high. Kim mentioned Microsoft is there as well. The other 493 stocks in the index had an average return of 16%, which in most years is fantastic, right? But when you look at the S&P 500 overall, that's up 26% year to date. That can leave a bad taste in your mouth if you didn't hold those 7 aforementioned stocks that we had there. So I think to answer your question, Stacy, for the rally to continue, we're going to need to see it more broad-based in 2024. Other stocks will need to carry their own weight. We've seen this over the past couple of months with small cap stocks in the U.S. dramatically outperforming large cap stocks. Carrie mentioned earlier that we can't really predict what's going to happen in 2024. We're not very good at that, and nobody's really good at that. But the one prediction I think I'm very comfortable making is that I don't think 2024 will look anything like 2023 did.
All right. Well, that's a good prediction. We'll be back in just a moment. Welcome back to Around the Table with Stacy Smith as we're taking a look at the economy and investing. We've talked about what may or may not happen in 2024. I'm going to kind of try to continue that theme. We've talked also about the Fed probably, maybe lowering interest rates in 2024. So, Frank, if that's what a lot of people are predicting, if that does happen, how's that going to affect the economy? And I'm going to have you focus in really on the housing market.
Well, the market has been positively affected by the perceived drops in interest rates. The fear that was pointed out earlier in the show was that if rates don't drop as much as anticipated, will that be bad for the market? I suspect it won't be good for the market. Now, how bad it'll be, it'll probably depend on everything else that's going on, like why they aren't dropping interest rates. If inflation's back, that means we probably still have supply problems as we've had, whether it be employees or commodities. And if not, then it might be that we're just in a recession, which is certainly not good for the stock market. That thing that people predicted a year ago that was certainly going to happen this year, that recession. And there will be one someday. As far as the housing market is concerned, I think lower interest rates create a lot of opportunity. Part of the biggest problem housing market has today is the lack of supply. There are people who are trying to buy homes, and there are people who have 2 and 3% mortgages that aren't going to move. And that problem is not going to go away no matter what happens to interest rates. So what we need to do is build more houses. And now that we've got these supply chain issues broken down, and we're starting to see some normalization of the employment market, we might be able to get homes built at a price that makes some sense. And the bigger developers like Pulte and Horton and Ryan around here and various Lennar, and those are the only ones I can think of at the moment, will get back in the development of housing plans again. And if you remember, they often offer financing to their buyers because they'll get a big chunk of money at a favorable rate and re-lend it to their buyer at a small spread, operating somewhat like a bank. And then they'll mark up their property a little more to cover the closing costs and this and that, and give them some relief to enhance sales so that they can increase the velocity of their money. And that is something that people don't generally understand, but turning the money over frequently will help returns for those businesses. And that being said, I think lower interest rates, no matter how much lower they go, will be positive. And if we get 6 cuts like some people are predicting, I fear that'll be for bad reasons, not good reasons.
There's also another good thing that comes from lower interest rates, and that's mergers and acquisitions. We're seeing U.S. Steel look like it's getting bought by a foreign company. And if you think about it, the rates over in Japan are way lower than they are here. So it's my guess that Nippon Steel is going to borrow money in, Japanese yen, convert it to American dollars, and pay out our shareholders over here. And they have a much better, financial situation because of the really low interest rates over there. The U.S. Steel acquisition doesn't have to add as much as if it were an American buyer at higher rates. But I'm also seeing a whole lot of attention being paid to other small companies that, because the companies that are interested in buying them can maybe refinance at lower rates in the coming years, they're going to be looking for mergers right now, and they'll do it with borrowed money, again, thinking that the interest rates will be favorable in the future.
I'd say, let me point out a couple of things that Kim and Frank touched upon is the interest rates that we care about as consumers have already come down quite a bit. So it's not what the Fed is doing on the short end of the curve, which is, important to banks and bank lending, but the 10-year bond is already down to 3.8%. It was at 5% not too long ago. Mortgage rates, which are indirectly, or so to speak, kind of tied to that, and longer dated rates have come down quite a bit, from close to 8% to now they're below 6%. So the market is already getting sort of ahead of itself a little bit in regards to what they think the Fed might do, because everything kind of works in harmony one way or the other there. So I think to Carrie's point before is, if the Fed doesn't cut as much as the market is predicting, that could certainly have negative implications for the stocks and the economy in general. Okay, the market's predicting 6 interest rate cuts by the end of 2024 as we speak now. We had 22 rate hikes since the March of last year, so we're going to the market thinks they'll cut 6 times. So I think there's a lot of moving pieces in 2024 that's going to really impact what the Fed's actually going to do, and then that's going to impact rates for the longer haul also. In regards to housing, if you can afford it and you need a house, there's not a better time than now to be buying one, in my opinion.
Yeah, and the one thing I'll add to this conversation about rates going down is that we're all making this assumption that inflation is under control, and we don't know that. I mean, we have some conflicts going on around the world. One that we're really watching is the one in the Red Sea, because if you start to disrupt trade and disrupt supply chains again, you might find yourself, at least globally, in a period where we get back into some kind of an inflationary situation. The situation also in the Middle East extending to potentially disrupt energy flow, although we're not as energy dependent anymore. It's still something that we all have to keep our eyes on to make sure that this inflation scare is truly behind us.
All right, with that, we have to take a break, and we'll be back in just a moment. Welcome back to Around the Table with Stacy Smith as we take a look at the economy and investing. And Carrie, I'd like for you to continue here for a moment, because you're raising some cautionary flags that we haven't heard about recently, and I've not really heard it nationally either. And that is the situation in the Red Sea, where the shipping is in peril with the Houthi rebels firing on these, and the United States is now trying to say it's going to guarantee safe passage of ships. This could really be a conflict, and not only for a political basis, but you're saying just for the economy, not here, but also worldwide.
Yeah, Stacy, the thing that always concerns me are the things that are going on around the world that aren't getting any coverage, because those are the things that surprise us. We talk every time we're together about, look, the market just doesn't like surprises. That's really the issue. And so generally, when we see things headlined all the time, even if it's negative, we're like, oh, okay, well, at least if it happens, it's not going to be a surprise, and, we'll continue. But it's a situation like this that, first of all, it is disrupting trade, because these shipping companies are now having to send their ships around Africa to get their goods from Asia to Europe. That adds a lot of cost, and it's very obviously disruptive to supply chains. And then you mentioned the situation with the U.S. being committed to making this safe, where you have these militant groups, firing missiles on cargo ships. So what does that do? How does that potentially drag the U.S. into some sort of greater conflict that then would potentially have economic repercussions? So, it's never safe. Investing in the markets are, there are no guarantees ever. And that's why I always go back to time frame, because you have to be able, the money that's invested in the stock market needs to have kind of a life cycle of at least 3 to 5 years to get beyond any shocks that we potentially may see.
Just to add to what Carrie's been talking about, something that is on the 4th page of most newspapers in a little blurb is the reality that there hasn't been enough rain in Panama, and the Panama Canal doesn't have a lot of water in it. And without a lot of water, they're offloading. They can't put as many containers on the ships they're taking through there, which means it's taking I've read 3 or 4 times the ships to get through there. And shipping companies are thinking about going around South America rather than going through the Panama Canal, just because it takes so much to get anything through there, or bring it into California and ship it by rail. I mean, they have options, but these options cost more. And shipping historically has been 10% of the price of what we pay for things. And if that cost goes up 20%, that causes 2% inflation. And so there's all sorts of things that could be happening that nobody's paying attention to, that seep into the just general stuff that means these interest rates just may not go down so fast.
I can't believe it's you two that sound like the doomers over me here. I mean, that's very uncharacteristic of you two. I actually take the other side of this. I think both of those are, while they're very important from a human services and a geopolitical standpoint, in regards to the markets, I don't think they'll have much of an impact on it. We had the Chinese ship that got stuck in the Suez Canal for a week and a half or something, and nothing could get through that. What was that, last year, I believe, or a year and a half? I'm losing track of time with COVID, after post-COVID. But I do think, to Carrie's point, though, that's a cog in the wheel of the analysis you should be doing day in and day out in terms of what you think is going to happen in the markets here. I do think Carrie raises a good point in terms of a cautionary tale in 2024, and that really does surround Fed rate cuts, the market getting way too ahead of itself in terms of things just really being a soft landing. We don't know that yet. The markets almost always rally after the Fed signals are done hiking, and then something inevitably breaks. Frank pointed out that a recession will occur. When it does, we don't quite know yet, but I would go into 2024 with my eyes wide open, just hopefully optimistic, but certainly cautionary as well.
To roll back to what Carrie always said, it's the reason when we allocate, we diversify assets. This way, hopefully, as in the U.S. steel building, we have our money on a bunch of elevators, and some of them are going up while some of them are going down. And your guess is as good as mine who's going to push the button on the 30th floor to change the direction.
All right, we only have about a minute to go, and I'm going to bring back in Kim on this one because you're the only one that has mentioned this, and that is a presidential election year, and your thoughts on how that might affect the markets.
Well, again, I think people are thinking optimistic thoughts. Either they want to keep the incumbent president and to have his mandate that he has, laid out go on, or there's a new guy or girl that comes in. We don't know, but it's generally an optimistic time. And I think that is what, kind of pushes the optimism of the market. Remember, markets are just capturing what people are thinking. And it's more than what they're thinking, it's what they're willing to do with their money. So these are some thoughts people have that have serious consequences. And that's why I love watching markets, because they really tell you at the heart what people are thinking and what actions they're taking. So always keep that in mind as you see numbers go up and down, that it's really people's thoughts and what they think is going to happen in the future.
All right, Kim, thank you so much. There is a lot more to discuss on how to manage your portfolios, and we'll do that in the upcoming sessions. I want to thank again Michael and Kim and Carrie and Frank for being with us for this entire year, and we're looking forward to 2024, and we hope that you join us then for Around the Table with Stacy Smith. Thanks for watching.